It's official. The Fed's tapering is starting this month, and they still think inflation is transitory. Hey guys, my name is Juan, and welcome back to my channel. And I'm gonna get right into the news. This is hot off the press, and you know what? The stock market liked what the Fed said today. So let's get right into it. There's three big takeaways. The first one is that the Fed is gonna start scaling back their monthly bond buying stimulus program. That stimulus program is the one that they set up last year in March, where they were buying 120 billion of mortgage-backed securities and treasury securities every month. They have been doing that since then, and this is quite a number here. The holdings of these securities in the Fed's balance sheet has doubled to almost 4 trillion since March of 2020. So they've been doing that, and they have been stimulating the economy, and we've seen the results, right? The stock market has been much higher since March 2020, and the real estate market has also been hot since March 2020. But so this month, they're starting to reduce that bond purchasing program by 15 billion in November and in December. And they expect to end the program in June 2022. So the second takeaway was that the Fed decided to leave interest rates unchanged at near zero. And this was expected. This was nothing new that we didn't know was going to happen. I thought it was interesting that when he was asked why they haven't started raising rates or why they haven't talked about raising rates, is that he said that maximum employment has not been reached, despite that we have 4.8% unemployment based on the September numbers. But they said that is not the same as if it would have happened before COVID, right? 4.8% would have been a better number, but now he's not so sure. And he did say that, he expects to reach maximum employment by next year. So take that as it may. And the third takeaway was that the Fed still sees current inflation as transitory. And they said the reason why they think that is because the supply and demand imbalance that we're seeing currently is related to the pandemic and the reopening of the economy. But they did agree that the risk is toward higher inflation. So they're seeing that, they're worried about that, but they still think that it's going to pass, right? Furthermore, they said they expect inflation to move down in the second and third quarter of next year. Now, with those three takeaways, my conclusion is that the Fed, as it has been shown in the past, they're usually slower to react to what's happening in the economy. And they're going to be forced to probably raise rates faster and sooner than they think, right? And this has been shown by this tapering that they're starting to do. This has been accelerated from what they thought initially, right? Initially, they didn't think they were going to start tapering until next year. So they've started this year. And that's because inflation has been higher than they have thought. So I think that is going to continue, and they're going to have to start raising interest rates sooner than they think. Now, I'm not, saying that the Fed is incompetent or anything like that, because I think that their job is really, really hard. I mean, it's a thankless job, right? Because they're never going to please everyone with whatever decision they make. So it is a really tough job, but it's a really important job. And in this case, I think that because of all the stimulus that the economy has gotten, not only from the Fed, right, the monetary side, but also from the fiscal side, I think it's just a matter of time before we really see more inflation in the system, right, in the economy. And for that, I'm going to link down below a couple of videos that I made from two different market participants. One is Jeremy Siegel, professor from Wharton, and then the other one is Paul Tudor Jones, who's a hedge fund manager talking about inflation. If you want to check those out, I will link them in my description. Yeah, they're more worried about inflation than the Fed seems. Although I do think that the Fed, like I said, it's a thankless job and it's a tough job that they're in, and they can't be too worried in front of the market, because that's going to create all sorts of dislocations. But also they can't just be too lax, because that's going to create also dislocations, right? Creating asset bubbles and then crashing, those bubbles crashing, which also creates all sorts of problems. And if they raise rates or taper too fast, then they risk creating a recession, which is not good either. In the past, from the 2008, 2009 real estate crash, and then from the 2000 crash, the Fed was not one to prevent anything from happening. They were usually just there to help, in the recovery more than to stop anything from happening. So I think it's probably, and this is my opinion, obviously, I think it's going to end up being kind of the same this time around. And I hope it's not as, inflation doesn't go as high as it went back in the 70s and early 80s, because then that would be really bad for not only the stock market, but also for the real estate market, and also for the, the economy in general. But with that, if you like the video, please give it a thumbs up. If you enjoy the content that I am producing in this channel, please subscribe. Let me know what your thoughts about inflation are in the comments down below, and I will see you in the next one. Adios.